Welcome to Introduction to Accounting, Preparing for a User's Perspective, Writing Off Bad Debts. In the last topic, you learned how to adjust the allowance for doubtful accounts account to arrive at a credit balance representing the amount of the company's accounts receivable that management believes will go bad in the future. For example, if the company's pre-adjusted trial balance shows a debit balance in accounts receivable of $200,000 and a credit balance in the allowance for doubtful accounts of $4,000, its pre-adjusted net accounts receivable would be $196,000. However, if based upon an accounts receivable aging analysis, management believes that 10% of its receivables will go bad, i.e. $20,000, management will need to adjust allowance for doubtful accounts by recording an additional $16,000 credit to the allowance account as follows: debit bad debt expense, $16,000. Credit allowance for doubtful accounts, $16,000. The entry above will result in net receivables of $180,000 being reported on the balance sheet because the adjusted trial balance will show a debit balance of $200,000 in accounts receivable and a credit balance of $20,000 in allowance for doubtful accounts. Let's now move on to the following year when management gets to find out for sure how much of its $200,000 in accounts receivable gets collected in cash and how much really goes bad and has to be written off against its estimated $20,000 allowance for doubtful accounts. In other words, during the following year, management will discover whether its $20,000 estimate of how much it thought would go bad was either overstated, understated, or exactly right. So what does management do when it knows that a receivable has gone bad? For example, what happens when customer DEF, who owes the company $5,000, declares bankruptcy and management has given up on all collection efforts? In this case, management is no longer guessing how much of this $5,000 receivable will eventually go bad. It knows that all of this $5,000 receivable is bad. In this case, management must write off the specific receivable against the credit it created when estimating its allowance for doubtful accounts at the end of the prior year. Here is the journal entry to write off the $5,000 account receivable. You should notice that whenever an account receivable is written off, you simply credit that customer's account receivable account. You should also notice that you reduce the estimate account by debiting allowance for doubtful accounts. In other words, you are pulling $5,000 out of the estimate account because it is no longer an estimate. We have actually found a receivable that went bad. Now let's assume that all of the remaining $195,000 in accounts receivable was actually collected in cash. We had $200,000 collectible, $5,000 was written off, $195,000 then gets collected in cash. In this situation, management would realize that its prior $20,000 estimate of potential future bad debts was overly pessimistic and was overstated by $15,000. This also means that at the end of the following year, its pre-adjusted allowance for doubtful accounts account will have a leftover credit balance of $15,000 computed as follows. We started with $20,000 in estimate, then we wrote off only $5,000, thus leaving an excess $15,000 in the credit of the allowance for doubtful accounts for the following year. This $15,000 leftover credit balance from the prior year represents that management overstated its prior year estimate of bad debts and overstated its prior year bad debt expense by $15,000, thus understating its prior year net income by $15,000 as well. Now, as of 12/31/X2, management will need to adjust the allowance account to reflect how much of its 12/31/X2 accounts receivable it estimates will go bad in the future. So let's assume that its 12/31/X2 accounts receivable are $220,000, but it estimates that only $12,000 of these new receivables will eventually go bad in the following year. What adjusting journal entry will management need to record as of 12/31/X2? In this case, management needs to reduce the leftover $15,000 credit balance from prior year down to only a $12,000 credit needed for the current year, and will record the following adjusting entry. Debit allowance for doubtful accounts $3,000, credit bad debt expense $3,000. So what does this unusual journal entry, which is crediting an expense, really mean? It means that management recorded $15,000 too much in bad debt expense in year X1 and is reversing that mistake in year X2 by recording a $15,000 credit to bad debt expense. However, management is also recording a new estimate of bad debts in year X2 for the new accounts receivable by debiting bad debt expense $12,000. The two entries described effectively net out to being a credit to bad debt expense of $3,000 as noted above. Here's another way of looking at it. Step 1. At the end of year X2, management notices a leftover credit balance in its allowance for doubtful accounts of $15,000 and says to itself, "Whoa, we really overestimated our bad debts last year. We better fix that mistake this year," and then records the following journal entry. Debit allowance for doubtful accounts $15,000, credit bad debt expense $15,000. So, year X1's overstatement of bad debt expense on its X1 income statement will get reversed on its year X2 income statement by understating bad debt expense by the same $15,000 amount, which also adjusts the allowance for doubtful accounts down to 0. Step 2. Next, management estimates that $12,000 of its year X2 accounts receivable will eventually go bad, so it needs to adjust its 0 balance in the allowance for doubtful accounts up to $12,000 as follows. Debit bad debt expense $12,000, credit allowance for doubtful accounts $12,000. Effectively, in this two-step discussion of the process, we reverse the prior mistake and zero out the allowance account, then record our new estimate. Each year, our bad debt expense is probably off a little bit because it is affected by reversals caused by prior year poor estimates. If you were to combine the entries from step 1 and step 2 above, you would arrive at our shortcut entry already described earlier of debit allowance for doubtful accounts $3,000 and credit bad debt expense $3,000. Because this shortcut entry reduces the number of journal entries and ledger posting that accountants need to make, this is what we use. In summary, it is a three-step process. 1. Determine what the pre-adjusted balance in the allowance for doubtful accounts is, which could be a leftover debit representing that management understated the prior year allowance and bad debt expense, or it could be a credit representing that management overstated the prior year allowance and bad debt expense. 2. Determine what the allowance's estimated credit balance should be based on management's best estimate of how much of its current receivables balance it believes will eventually go bad. 3. Record an adjusting entry to adjust the allowance account from the pre-adjusted carryover wrong number in 1 to its best estimate adjusted number in 2. My recommendation is that you focus on the logic of this process. Try to avoid just memorizing the entries. Think about what management is trying to do in order to provide useful financial information to its users. If you will focus on and understand the logic of this process, you will have accomplished much. Good luck on the quiz.